Sony Pictures. Entertainment Inc. is a subsidiary of the Sony Corporation, primarily involved in the production, acquisition, and distribution of films and television content. It stands as a major player in the entertainment industry, known for blockbusters and significant television shows which have global appeal. This prominence in the cinematic and television sectors makes its financial health an indicator of broader market trends. Sony Pictures operates under various divisions including Columbia Pictures, Screen Gems, and Sony Pictures Television, among others. Each division targets different segments of media consumption, from mainstream cinema to niche TV markets, providing the company with diverse revenue streams. Sony's commitment to innovation and content diversity has helped it to remain competitive in a rapidly changing industry. However, recent financial reports have shown a dip in profits, sparking discussions about underlying causes and future strategies in the face of industry-wide challenges. Sony Pictures reported a profit of $808 million this year, a noticeable decline from previous years. This dip has caught the attention of industry analysts and stakeholders, prompting a deeper look into the financial health of the company. For comparison, just 2 years ago, the company celebrated record-breaking profits, highlighting the volatility and unpredictability of the entertainment market. The decrease in profit can be attributed to a combination of lower box office returns and increased production costs. Films that were expected to perform well did not meet expectations at the box office, which significantly impacted the overall profitability. Additionally, the global economic slowdown has reduced disposable income, affecting moviegoing habits worldwide. Investments in new projects and enhancement of digital streaming platforms also required substantial capital, which could have contributed to the short-term decline in profit. These strategic investments are aimed at long-term gains but pose a challenge to immediate financial outcomes. Several factors have contributed to the profit decline at Sony Pictures. Primarily, the global pandemic had a lingering effect on production schedules and theatrical releases, disrupting traditional revenue streams for major studios. Films like Morbius faced delays and underperformance which directly affected financial returns. Market saturation and increased competition from other studios and streaming services have also played a role. As companies like Netflix and Amazon Prime Video continue to invest heavily in original content, traditional studios face stiffer competition, not just in attracting viewers but also in maintaining profitability amidst rising content creation costs. Furthermore, the rise in digital consumption has shifted audience preferences. While this opens new revenue channels like direct-to-consumer streaming services, it also challenges traditional revenue models based on theatrical releases, requiring adjustments in how content is monetized. In response to these challenges, Sony Pictures has made several strategic decisions. The company has increased its focus on digital streaming platforms, recognizing the shift towards online consumption. By enhancing its presence on platforms like Netflix with exclusive deals, Sony aims to capture a wider audience and open new revenue streams. Additionally, Sony Pictures has been selective in its film projects, focusing on franchises and proven genres that promise higher returns. This strategic focus is intended to mitigate risks associated with unpredictable box office performances, especially in a volatile economic environment. Collaborations with other major studios and cross-platform ventures have also been part of the strategic realignment. These collaborations aim to leverage shared strengths, reduce costs, and maximize market penetration, reflecting an adaptive approach in a competitive industry. The film industry is undergoing significant transformation, influenced by technological advancements and changing consumer habits. The shift towards streaming and on-demand entertainment is perhaps the most significant trend, affecting how studios like Sony Pictures operate and strategize. In addition, there is a growing emphasis on international markets. Studios are increasingly tailoring content to appeal to global audiences, which involves not just linguistic, but cultural adaptations. This global approach can potentially open up new revenue streams and diversify audience bases. Environmental and ethical considerations are also becoming critical in production decisions. Sustainable practices are being integrated into production processes, and there is a heightened focus on diversity and inclusion both in front of and behind the camera, aligning with broader societal shifts. Sony Pictures' recent profit decline is not just a reflection of internal corporate dynamics, but also an indicator of broader industry challenges. The shift towards digital media, the impact of global economic conditions, and intense market competition dictate a strategic reevaluation and adaptation. For stakeholders in the film industry, this serves as a call to reassess traditional business models and embrace innovation in content delivery and audience engagement. Looking forward, the ability of major studios to navigate these changes will determine their place in an evolving entertainment landscape. As the industry continues to evolve, Sony Pictures and its counterparts will need to remain agile, proactive, and responsive to both market demands and technological advancements to sustain profitability and growth.